Hello and welcome to LBMA webinars. We are delighted to welcome back Ross Norman, independent consultant, our host for today. And joining Ross will be Jim Steele, Chief Precious Metals Analyst for HSBC, and Suki Cooper, Executive Director, Precious Metals Research at Standard Chartered. They'll be discussing US election, gold and the economic recovery shape. If you have any questions during this webinar, please submit them during using the Q&A function at the bottom of your screen. And now, without further ado, I'd like to hand over to you, Ross.
Thanks very much indeed, Sophie, and a big warm thank you also to the LBMA for hosting a seminar for us. I've got a real treat for you today. We've got two of the youngest, brightest minds in the world of precious metals here to inform and to entertain us, I hope, as well, about what's going on, particularly with regard to the US elections and perhaps the shape of the economic recovery, if we have time to cover that. Please do put questions forward. There's nothing that these guys wouldn't be happy to field. They're great sports. 4 years ago, Jim, Donald Trump had his inauguration. Do you remember what the gold price was then? $1,200. It's done 60% in 4 years. That's 13% nearly year on year. Not a bad game. The question on everyone's minds today is, it looks complicated, but run us through the permutations in terms of what we could be looking at in terms of the election, in terms of the House, the Senate, and the presidency.
Yes, and it's not clear, but I think we have 5 basic scenarios. One would be a clean Biden sweep. I should say we are completely apolitical as far as this is concerned, but the polls at the moment, I'm not saying me or HSBC, but the polls seem to be favoring that. And by a clean sweep, we mean a Democratic victory in the White House and also a retaking the Senate, which is now in Republican hands, and holding on to the House of Representatives, the lower house of the Congress. Now, the next one would be a Trump a clean sweep, which would be retaining the White House, retaining the Senate, and winning the House. This looks unlikely, very unlikely, given, especially for the House, given the polls. The other one would be a divided government. That would be a Biden victory, and most likely the Republicans holding the Senate, but keeping the House, and the same with Biden winning the White House, not winning the Senate, but holding the House. The fifth one, which would be a delayed result, and I guess as a subclass of that, one could even put a disputed result.
Fine. I mean, certainly looking at the polls, Biden's secured a 10% lead there or thereabouts. Polls, as we know, are unreliable. We saw that at the last election. If you look at the betting money, which I prefer to look at, the gain is less convincing. It's somewhere looking, if you follow the money, it's somewhere around 6% of that order of magnitude. But certainly the media seems to be convinced that we're going to be seeing a blue wave, which is to say a clean sweep for Biden. Let's talk through the ramifications for that, and by extension, what in your mind, Jim, that would mean for gold.
Well, I think that it's all got to do with risk. And much of it will be how the dollar reacts. So we could see, and I say this initial, and emphasis on the initial, we could see some initial gold weakness if the dollar gains on risk-off sentiment. So if a Biden victory sets off risk-off, increases risk-off appetite, the equities weaken, more money goes into treasuries because of uncertain about regulatory reforms and tax policies, and possibly more spending, or very likely more spending, and that triggers risk-off sentiment, then we could see money coming into treasuries, we could see a strengthening dollar, and that would initially weaken gold. Now, part one. Part two, which would be presumably much longer lasting, which would be an eventual rally back based on fiscal expansion. Although we could see some of those gains moderated if a Biden presidency were a little bit softer on trade and went to smooth geopolitical strains right now.
Certainly, there's a sense, as you say, longer term, that the Biden administration, should there be one, would be very much print and spend. It's going to be very front loading of spend on infrastructure. They're talking about $2 trillion on top of the stimulus spend. It's extraordinary. We talk about $1 trillion like in the way we used to talk about $1 billion. Did you know, I read about this morning, if you had to count to 1 trillion, it would take you 220,000 years. That's longer than humans have ever existed. Yet we discuss these big numbers in a trifle. So let's go through it. So we think that under a blue wave, as it's called, we could see an initial weakness followed by strength because Biden is not Main Street friendly, increased corporation tax and increased debt coming to weigh on the dollar, and therefore a gold positive story. Something of a J curve, if you like. Would that be said?
That's right. And it's all going to depend on how the risk appetite moves and importantly, how the dollar moves.
Let me finish with you, Jim. So let's also look at the other scenario, which is Trump does rather better. He's always apt to surprise us. Let's say he wins, not say a clean sweep, but let's say he wins the presidency, probably with a broken house. What would that mean? Would it be more of the same?
Very likely. Very likely. If we get a Trump victory and legislative gridlock, which would be the Democrats at least holding the House, and they could still conceivably take the Senate and lose the general election, lose the presidential election, then I think we would see more of the same. We would see some probably continued positives for gold through trade. There's an inverse relationship between gold and trade tensions. So if trade tensions were to rise, that would be positive for gold. The geopolitical situation would be positive, but also there would be some restraint on the president, as there is now with divided government. So that would probably be more of the same of what we're seeing now. So firm, but not necessarily electric.
Great. Let's bring you into the Suki, this conversation. Let me start by reversing the question, if I may. We're looking at the politics and by extension, how it could impact the dollar or treasuries and therefore by extension gold. If we look back over the last year or so, the key drivers, and you may disagree with this, have been a weakening US dollar, but also falling treasury yields. What do you think is likely under the two political scenarios that Jim has given us?
I would agree with you, Ross. I think the two main drivers have very much been real rates and the dollar. What's been interesting is they've been competing with each other, which one has been the main driver. And I'd say until about July, August time, real rates mattered the most for gold. But since then, we've seen a switch towards the relationship with the US dollar becoming much stronger. And interestingly, we were looking at the correlation between the dollar and gold leading up to elections. And in the past 6 elections, it's been an incredibly strong relationship. It's a negative correlation of over 50% on a 1-month rolling basis. And in 6 of those elections, we've actually seen that correlation remaining strongly negative at the time of the election and immediately afterwards. And in 3 of those instances, we actually saw that relationship strengthening even more so. So I'd say in the current environment leading up to the election, but given the broader macro environment, the dollar remains the primary driver at the moment. And I think that's the initial reaction we'll get from gold prices.
I thought it was interesting. I looked back at all the presidential elections to 1971, looking at the Republican administrations and the Democrat, and there isn't much correlation between the one and the other. If you looked at the gold gains on each of them, actually the gold gains in the Democrat administrations were larger, only because of a couple of anomalies. But the reality of one administration or the other doesn't seem to favour the one outcome or the other. Jim, so looking forward, I mean, you get a vote and Suki and I don't get a vote. But gold, if you're a gold bug and you wanted a good outcome for the gold price, what outcome would you be hoping for in the elections to see us strongest? Is it a blue wave clean sweep for Biden? Is it the slightly broken Trump administration, ongoing tensions? Which is likely to be a stronger drive? Hard to say, perhaps. What's your sense on that?
Well, I would just make a quick comment about what you said earlier, Ross. Then you're absolutely right. There is only a very modest positive when we looked at it for gold and Democratic presidential elections. Where the Republicans tend to gain would be if there's a steep foreign entanglement. But what I would just point out quickly, but before I answer your question, is presidential popularity is very important, be it Democratic or Republican. Ronald Reagan and Bill Clinton were extremely popular, and gold fell very sharply. In fact, it bottomed out on both there. So, and the other one was less popular, George W. Bush and Carter, and gold jumped under both. Also, Barack's popularity went up and down. So with gold reacting. So if you look at the Gallup polls on the popularity of the president and other Western leaders, that's important too. Now, I would say longer term, to your question, it would probably be a Democratic clean sweep. But it's a close run bet, because there are a lot of positives for gold from a Trump presidency. And mostly, I think, generated if we have a divided government by uncertainty and possibly the trade outlook. He's already said, by the way, that he wants a big fiscal package. So he seems to be narrowing the difference between him and a Democratic presidency. So that might not be quite as different as it would have been a few months ago.
Certainly this stimulus has gone on, and you're wondering who it's favoring. It's difficult to sense whether it will be pushed through. I'm surprised by the size of the Trump gift, if you like. I think he was talking about 1.6, 1.8 trillion against 2.2 that the Democrats were looking at. And on top of that, of course, the Democrats looking at this Bidenomics, as it's called, a massive infrastructure spend thereafter. At some point, and we're going off from the elections here, at some point, this debt has got to be paid. Debt to GDP ratios must be going through the roof. I mean, Suki, how do you see this playing out?
It's really interesting, because I think for gold, it's very much these macro dynamics that are going to be pivotal in the initial aftermath of the election, but also for the months after the election as well. So I think when we're looking at the dollar reaction initially, under any outcome, we think that the dollar is going to weaken. We might get dollar strengthening in various scenarios, and we think this most likely if we have a contested election or a delayed result, then you might see the dollar benefiting. And I think it's very much the reasons that Jim has already mentioned, that you might see some positioning alteration, might see some risk off appetite. And that's a scenario where we think there might be opportunities for those who want to have a long position in gold to actually come in and look for that volatility, uncertainty, pressure in gold prices lower. But the bigger picture is very much being driven by the stimulus developments. And we've seen that over the past couple of weeks. Every time gold has got a little bit of a bounce, even though it's been oscillating around that 1900 level with strong resistance above it and strong support levels below it, it's been primarily on the back of stimulus developments. So I think gold is very much looking for the next package to get that next catalyst, that next boost higher. But debt to GDP ratio has spiked in a number of countries. In the US, and we're at over 100%. And when our economists have a look at this, they're saying that debt to GDP ratio is higher, is perhaps the highest or record levels in peacetime scenarios. So it is incredibly high. Negative yielding debt around the world is around about 25%. So this is creating a very gold favorable backdrop. Lowering the opportunity cost of holding gold, concerns around further stimulus, which Powell's already indicated that we need to see the US economy to continue to recover. But in terms of the outlook for gold, we still see it as one of the key and perhaps most supportive dynamics of gold. So whether it's just under 2 trillion, or in some conversations we've seen Biden talking about up to 3 trillion in terms of spending, all of these scenarios paint a picture that is very favorable for gold.
Now, you both, I think, if I summarized you correctly, suggest we could see a little bit of gold weakness post the election, but the broad themes and macro trends will maintain and continue higher. I suppose a caveat to that, Jim, would be a disputed election, or that would create ongoing uncertainty and presumably feed very well into gold.
Yes, I think that's right. I think if it's disputed, there's a reason why the president the vote is in the beginning of November, and the president does not take office until January 20th. There is room, as we saw in the last disputed election, which was the Gore-Bush election, there is room for this to be adjudicated. It went to the Supreme Court back then. Now, at that time, gold did not rally, interestingly enough. We did not see a big move. Now, gold was in a bear market back in 2000. It was just coming out of the Washington Accord, and it was before 9/11. So it's interesting that we did not see a big rally, but I do think that gold would feed in from the uncertainty this time. And we could see one of the unusual instances where gold and the dollar would perform better together because of the uncertainty. We could see, as we did during the global financial crisis for different reasons, investors going into treasuries and gold simultaneously. That is possible. But of course, nobody wants something that's disputed. The only thing I would mention as well is that last time we had the previous election, which was a surprise because we had very significant coin and retail bar purchases running right from June and July right through to early November. And when Trump got in, we saw a wave of liquidation there, and the coin and small bar market did not recover for many quarters.
I've got this theory, and I can't substantiate it, that silver is very much a US phenomena. We saw that during this year when we had first quarter ETF buying by European institutions, and again, silver didn't move. Second quarter, US institutions came in behind the ETF, and finally, silver joined the party belatedly. If what you're saying, Jim, is true, then by extension, silver should look a pretty good bet on the basis that American uncertainty often leaks into silver as much as into gold, whereas here in Europe, we tend not to get silver quite as well. Would you follow that line of thinking?
Yes, and I meant to say that both silver and gold coin bar in retail demand, not just silver, just to clarify that. But yes, I mean, the US was on a bimetallic standard. We were on a gold and silver standard. Only other country to be on a silver standard was China. Everybody else was on a gold standard. So yes, and that goes along with going right back to Comstock days and things like that, where silver was very important to the US. So, but I would agree, silver is sometimes the second derivative when the gold moves, and the silver then, as we've seen just recently.
In fact, yes, it's my view that silver's actually led gold in the last few days when gold has struggled and needed a confidence boost. Silver coming through a technical resistance level has given gold the confidence to move ahead. We talk here about the political developments, Suki, and you'll know the expression, when America sneezes, the world catches a cold. What happens there in the States, and you're both in New York, I think, will matter to the rest of us. Give us an idea, Suki, if you would. Paint us a picture of where you see the global economy over the next short few months. Part of that could be politically driven, but perhaps you want to touch on the broad macro themes. What's your thinking?
I just wanted to add quickly on silver, actually. I think when we look at the political outcomes, a Biden win with a Democrat Senate as well, perhaps paints an extra positive picture for silver as well, whereas we might see some of that silver investment demand continuing to grow, and it's been at a tremendous pace. But given the discussions around the green energy plan, and if we start to see this investment into alternative energy and clean fuel, maybe the solar industry could benefit. So this could be a scenario where you not only see strong silver investment demand, but you start to see strong silver industrial demand as well. So silver could see that boost, that higher performance than gold on back of its industrial and investment properties as well. But when it comes to the political outcomes, the different scenarios that we've gone through, I think for the broader economy, we are still expecting a dip in global growth of around about minus 3.6% for this year, and a slow recovery into 2021. We are seeing somewhat of a dichotomy between the pace of recovery that we've seen across Asia, across the Middle East, compared to the pace of recovery that we're seeing in the US and across Europe. In the US, we still expect GDP to contract by 5.4%, and then a very slow recovery from, of course, a very weak base in 2021 of just over 2%. So we very much see a slow recovery.
Certainly, China seems to have successfully executed a V-shaped recovery. In the West, on the other hand, it looks a little bit more like a Nike swoosh, doesn't it, really? There is a sense of stalling. Look at economic activity indicators. We're seeing the economy stalling, US consumer card spending stalling, the Baltic Exchange Index. Most of them seem to suggest that the economy is stalling at the moment. And your view about it is presumably largely from a Western perspective. We don't seem to have the growth that we hope to get. We're not really back to where we hope to be, are we?
Some of the data has been has recovered quite quickly. Some of the manufacturing data, but as you say, it's not been an even recovery on a global basis. And under the various political scenarios, you might start to see some of the trade relations improving. But our highest view is that irrespective of the presidential election outcome, we're still likely to see that continued momentum in China trade negotiations continuing. It might just be a different strategy in terms of how it's executed. But we think in terms of the technology, in terms of exports, opening up the economy, we think those conversations are likely to continue. Maybe across other regions, say with Europe, we might see a change in stance. But we think a lot of the motions that are already in place will continue. So in terms of the economic recovery, I think from different countries, we could see a slightly different pace. But the main risks are really around the second wave or third wave of infection rates and the development of the vaccine. And I think that's also the biggest risk for the gold market in terms of upward momentum as well.
Well, I want to dig further into the economy and what it would look like with both of you in just a moment, particularly in relation to, we've touched on the dollar, let's treasuries and global growth, and by extension for gold. But for those of you listening in, here's your chance to participate in what your thoughts are. Obviously, please do ask us questions. You've got the buttons there to do so, and we'll field those at the end. But before we do that, I'm going to ask Sophie to put up a poll for you. We will be having a rerun of this presentation on the 12th of November, when the three of us will convene to see what actually happened. Now, what do you think? What do you think the outcome is in terms of, we're not asking you to vote on a political outcome, but where you see gold going between now and the 12th of November. Do you see gold going relatively statically, a little higher or a little lower? If I could ask you, if you can, just to press a button. I don't know if we, hosts and panelists cannot vote. We'd like to push a button on there that we can comment around on what we're hearing from you guys listening in onto this program. While you're doing that, Jim, I'll come back to you if I may. My sense from Suki is that the House view, here we go with let's come back to that in just a moment. The red line suggests the majority of you believe gold is going to be firmer in the 1950 to 2000 bracket at 36% of you, shortly followed by 1900, 1950. In short, the weighted average is probably somewhere around 1955. So you seem to be saying, as a group, that gold will firm in the next 2 or 3 weeks. Happy with that prediction, Suki and Jim, in line with your thinking?
Yes, we have an end of year of 1965.
Suki?
We're forecasting a quarterly average for Q4 of $2,000 per ounce. So we see there's more upside risk for the gold market. We're also expecting a substantially weaker dollar over the medium term for the next quarter and going into 2021 as well. So we think some of these macro drivers are going to boost gold prices a little more so than where the poll is perhaps suggesting.
Okay, well, let's explore this further, this idea about the economy, but in particular those things which affect gold. We are gold pundits, not political pundits after all, although we all think we have a view. Jim, the negatively yielding government bonds has been a key driver, and you follow Suki's view that latterly the dollar has come into play now, the weakening US dollar as the key driver for gold on an intraday basis. Would you agree with that scenario?
Not necessarily the weakening dollar, but definitely about yields. We are looking for 50 basis points for the 10-year at the end of the year, and around about very low in nominal terms. So in real terms, significantly lower. In real terms, and also we have outright negative in many countries. You said about 25% of all the bonds issued now, roughly. And so really this is tailor-made for gold. I mean, I do remember being in an economics class many decades ago when the professor said there can't be negatively yielding nominal bonds, and we all wrote it down. We cannot have negative. Well, he was the boss. I mean, we thought he was right, and that's been proved wrong. And this has been tailor-made for gold. And what's important to remember is that we rallied 17% last year, mostly between August and December, pre-pandemic. So we were in a bull market ahead of the coronavirus. But I really have to endorse what Suki said. I mean, a vaccine could change the outlook. A steep second or third wave could change things. And I mean the global outlook. I don't mean the outlook for gold necessarily. And that in turn would impact gold.
Interesting. We talk about US treasuries here. I did a calculation the other day. Do you know the size of the US treasury markets as an entirety? It's 12,500 billion. Remember that figure, 12,500 billion. If you look at the inflows into gold ETFs, and if you assumed that all of those inflows were refugees from the US treasury markets, then roughly 0.2% of US treasury holders have migrated into gold, a fraction. We're talking about David and Goliath here. In other words, if you saw 1 or 2% move out of long-term negatively yielding US treasuries, that would consume the entire global gold mine production in one go. So we talk about gold as if it's a great, massive asset. Jim, we're what, 0.5% of global assets under management?
You're absolutely right. It's big to us. And once again, I'm going to claim the title of world's biggest precious metals analyst. Suki's the loveliest one. But it is relatively small. And we did similar calculations, and I'm sure Suki has in the past also, about when we saw central bank buying. I mean, just to move off the topic of the narrow topic of the elections just for a moment, with several $1 trillion, were China to increase their foreign exchange reserves between 5 and 10% of their reserves compared to what they are now, that would also account for a huge slice of the gold market. So we don't need much leakage from one of many sources. But I do hasten to add that the money that might have gone into treasuries also has many other avenues, there's property, there's all sorts of things, you know.
We're going to go off piece here slightly. We've talked about the elections. We've touched on the economy. My sense is that the momentum behind gold has also, Suki talked there about how the economic energy has come out the market slightly, we've flatlined. We've seen the same in gold, haven't we? That those flows into gold on the ETFs have been slower in the last 2 months. Central bank buying has slowed up. Is this a natural phenomena? Could we be in a protracted period of consolidation? What's your sense, Suki?
I think the ETF flows are fascinating to look at the moment. If we go back to 2013, we know there was some switching out of ETFs and a preference to hold outright metal instead. But it was almost a leading indicator in terms of started seeing disinvestment across longer term strategic investors before we saw that sharp sell-off in April 2013. And I think this time round, it's important as well, because when we've seen those sharp corrections in August, on August 11th, we saw a $100 correction in late September. Yes, there were ETF outflows, but they were quite limited. They're only around about 20 tons, which is significantly less than what we saw during the March sell-off when COVID was declared a global pandemic. So I think the ETF flows are certainly resilient, but to me, it's fascinating how the strength on the investment side has more than offset the weakness that we've seen in the physical market. If you look at the data during the global financial crisis, or just from last year, the growth that we've seen on the investment side has not only helped prices to set all-time highs as we did back a few weeks ago, but it's also offset the weakness in the physical market to make up for that shortfall. So the investment demand has been incredibly strong. But yes, I agree with you that ETF flows have started to slow down, but they're still very much robust. Even tactical positioning hasn't been that strong. We were at all-time highs back in late February, March, depending which measure you prefer to use. But tactical positioning at this stage ahead of the election is relatively light. It's only around about 21–22% of open interest when it comes to managed money positioning, which is much lighter than where we were for the previous two elections. But with the slowing down of some of these physical flows, I think it's a reflection of gold prices being caught in this tight range technically, but there isn't an outright catalyst just now, whether it's from the physical market or whether it's from the investment side, to really push prices out of that range. So perhaps we're going to get more of that catalyst or more of the momentum starting to materialize after the election, and then we'll start to see more meaningful positioning coming back into gold.
Well, let's stick with ETS, because I think that's probably the key driver just now, or has been for a lot of this year in gold. I know, Jim, that you at HSBC have a particularly privileged view of flows, and you have a very strong position within that space. I wonder how right Suki is. I mean, are we, and I know StoneX have reflected this view as well, which is, are we vulnerable? What's the quality of the buy in the ETF? Are we facing a potential 2013 collapse in confidence as the economy?
Well, I was just, yes, I was just about to bring up 2013. But I think the big difference, well, what happened in 2013? Well, we had a big exit for those youngsters that may not remember in the audience. We had a big flow out of ETFs, quite dramatic. They had gone up very strongly in the global financial crisis. But what triggered and what happened? Well, we got a big drop in the gold price, and then we had the entrance of China. And they're the ones that stopped it from going below $1,100. As China came in and absorbed that gold, the market then began to go up. But what triggered that decline was a change, or a perceived change, in Fed policy. Fed policy actually didn't change as quickly. We didn't move away from QE and unconventional monetary easing. Well, that's not on the cards this time. The Fed have made it pretty clear, from Jackson Hole especially onwards, that they're willing to tolerate inflation above 2%. And the spigot is on. Monetary policy is going to be easy, and it's going to move at least through 2021, according to our economists, into 2022. So it's unlikely, if the reason for big declines, sustained declines in the ETFs, is a perceived change in US and global monetary policies, then that's not on the cards this time. And but I agree, we need to see some moderation. I mean, they're up almost 1,000 tons from the beginning of the year. This is almost a third of mine output. So we've seen an enormous increase.
Suki, we talk about ETF demand being off the scale, but we can't forget the fact, and this is a question that's just come up, India and China, demand has absolutely created. The #1 demand center for gold is almost non-existent, and even central bank demand has come off. We've seen a massive pivoting, haven't we, of gold demand from being a very Eastern-centric thing to being a Western-centric thing, and flows accordingly have been challenged. What's your sense about demand in those regions, and looking at discounts? Do we think that they're finally getting used to these higher prices? Is demand coming through just yet, or do we have to have lower prices before they come good?
We've started to see a very modest improvement. If we look at the August import data for India, it was actually firmer year on year, but it's from a very weak base on a month-on-month basis. So we are starting to see something of a recovery, but we're still also seeing heavy discounts across key markets as well, especially in China. We've had record discounts in contrast to the LBMA price. So I think the recovery is likely to be very slow. Yes, there's pent-up demand, and I think some of that will start to materialize. But in terms of local price levels, they're perhaps still a little bit too elevated to really attract some substantial volumes to support the downside. But I do think that we'll start to see some more buying. When it comes to festival-related buying in India, I think some purchases will take place, but perhaps there'll be smaller quantities than they would have been ordinarily. We're also seeing a slight improvement in foot traffic. So I'd say they're very small steps in towards normalization. But even before COVID, we started to see weakness across the physical market. In India, the local demand was already down in January, February. In China, it was a slightly different story. We started seeing quite a firm response in terms of the physical market ahead of the Lunar New Year, but that momentum was dampened very, very quickly. So I think we're expecting a scenario now where, yes, the physical market recovers from the very weak levels that we saw across June, July, but it's likely to be a very slow recovery. And at the moment, it hasn't really been critical for the gold market because we've not really tested that floor. The physical market is crucial in the support levels, but we haven't tested that yet.
So Jim,
if I could just jump in for just a second on that to reinforce what Suki said. And Ross, I'm delighted on that question because I wanted to bring that topic up. The underlying physical demand is often not discussed. I mean, it's very easy if you're the august Ross Norman, or you're at Stan, or you're at a bank, or you're at HSBC, not to think about the underlying jewelry small bar demand. I mean, the average bar that's bought in India is as low as 10 grams. And in China, it's typically 50 or 100 grams. And this price and the jewelry price is only a modest markup compared to Western markets. And so the change in price comes very quickly into, and it's more modest income levels that purchase this. So if you want to know where this gold that's gone into the ETFs has come from, I mean, the declines in the jewelry market have been really quite significant. I agree with Suki, there's going to be a recovery, but we've really got to appreciate that this was the principal physical demand source for gold, and it's way, way down.
I think certainly if one looks at the discounts in Loco Shanghai, currently I think it's 35% below spot. It has been minus 50. It gives you a good indicator, I think, of a beginning of a resurgence of demand from those regions. Not enough to entirely support the market. That image you're seeing.
This makes us reliant on the investment. This makes us it's a highly investment reliant market, and that changes quicker than jewelry demand.
Do you know, I could have this conversation all day if time allowed, and you've been fantastic guests. So I have to thank you both. We haven't touched on inflation, central bank demand, so much more we can do. Perhaps on November 12th, when we reconvene, we can touch on those points as well as discussing the outcomes of the US election, however that plays out. But you've been both very great to have given your time. I know you've got up at 5 or 6 in the morning, and I know, Jim, you should be on holiday, so my gratitude to your wife as well for releasing you. Thank you both very much on behalf of the LBMA. I think in summary, the feeling is that gold, the broad threads and themes that drive gold will continue. If we have a disputed election, that could give gold a lift. Without that, with a clear run decision, we could see a dip in the gold price, which I would argue might provide a good buying opportunity. But broadly speaking, gold's on a course of action, which the election might just be a break in its stride. Let's see. Thank you again, Suki and Jim. You've been great guests. And back to you, Sophie.
Thank you, Ross and Suki and Jim, for that dynamic discussion. I think last week we promised charisma, and we have definitely delivered and more. So we hope that the audience today would like to rejoin us on the 12th when you look at things at the other side of the election. Before then, we have something coming up in October we're about to announce, so please do keep your eyes peeled for that. On the 5th of November, we have part 2 of our Digital Gold webinar series, so please do join us for that. It just remains for me to say thank you to everyone that registered and that's listening right now, and we hope that you have a wonderful day and a great weekend. Goodbye for now.